Welcome to the deep dive. Today, we're cracking open a really important document. It gives us this rare, detailed look under the hood of a company trying to, well, build the future of digital money. Crcl Internet Group.
That's right. Our source material for this deep dive is Crcl's latest S1A filing. It's dated May 27, 2025.
And as you probably know, an S1 is, well, it's the absolute deep dive requirement for any company looking to go public. It's where they spill the beans to the SEC and to potential investors like you about pretty much everything.
Yeah, their business, their financials, and importantly, every single risk they can possibly think of.
Think of it as Crcl's detailed story, told in their own words, but under the intense scrutiny that comes with wanting to list on a public stock exchange.
Exactly.
So our mission today, let's cut through the dense language, the hundreds of pages. We want to pull out the most important stuff, the nuggets of knowledge, and really get a handle on what Crcl is, according to this filing.
What drives them, what are their big plays, and what keeps their leadership up at night?
Yeah, let's unpack this complex picture.
Okay.
All right, let's start right at the top. How does Crcl actually describe itself? What's their core ambition in this filing?
Well, they open with a pretty bold mission statement. Quote, to raise global economic prosperity through the frictionless exchange of value.
Frictionless exchange of value. Okay.
And their vision tied to that, building a programmable protocol for dollars on the internet.
Programmable dollars. That sounds like the big idea they're really selling here.
Precisely. And the core product that sort of embodies this vision is their stablecoins, mainly USDC and EURC.
Yeah.
USDC, the US dollar one, that's the anchor, launched back in 2018.
Right. And just to quickly level set, because you follow the space closely, a stablecoin is that type of digital asset designed specifically to hold a stable value, right? Unlike Bitcoin or Ether.
Exactly. Its value is pegged, or supposed to be pegged, to something like the US dollar in Crcl's case.
It tracks the dollar.
Right. And the filing paints Crcl as very much a product and technology-led company. They emphasize significant investment, past and future, in R&D to build out this whole infrastructure.
Okay, so filing this S1, it's a massive signal. They intend to become a public company. How does a filing talk about their relationship with, like, the public eye and regulators?
Yeah. They acknowledge they've been operating under intense public scrutiny and regulatory supervision for a long time. Kind of comes with the territory, operating digital dollar infrastructure.
Makes sense.
They explicitly state they take their role as a steward of financial assets very, very seriously. They see themselves as a global financial institution.
Which is, crucial messaging when you're dealing with people's money and trying to navigate all that regulation.
Definitely.
Now, for a stablecoin issuer, you could argue the single most critical thing is what's actually backing the coins, right? How does the S1 detail their reserve management? This is key.
Absolutely central to the whole operation, to maintaining trust. The S1 details that they hold reserves in a way specifically designed for liquidity and preservation of principal.
Meaning safety and access.
Exactly. Not for maximizing yield by taking on risky investments. That's a key distinction they make.
And how are those reserves actually held? Because, this has been a huge point of contention for other stable coins that, well, didn't make it.
Yeah, this is a critical insight the S1 really hammers home. The reserves are held in accounts explicitly titled FBO holders of USDC and EURC.
FBO, for benefit of.
Right, for benefit of the holders. And this is key because it signifies legal segregation from Crcl's own, operational funds.
Ah, okay, separate pots of money.
Exactly. And the filing goes to great lengths to state they do not lend, borrow against, or otherwise encumber these reserves, period.
Okay, that legal separation and the no lending rule, that's a major differentiator. They clearly want the market and regulators to understand. What specific assets are actually in these segregated reserves, then?
The S1 states they're limited to highly liquid financial instruments. A significant chunk is held in the Crcl Reserve Fund.
Okay.
And this fund is managed by BlackRock. Notably, Crcl is the sole shareholder of this fund.
Managed by BlackRock. Okay. Tell us more about that fund structure, because the notes mention it's specifically regulated, right?
Yes, and this is where the regulatory piece connects directly with the reserves. According to the S1, the Crcl Reserve Fund operates as a government money market fund under a specific SEC Rule 2A7 of the Investment Company Act.
Rule 2A7. Why is that significant?
Because Rule 2A7 funds are highly restricted. They have very strict rules about what they can hold. They must invest at least 99.5% of their total assets in cash, U.S. Treasury bills, notes, and other qualifying government money market funds.
So super safe, short-term government debt, basically.
Pretty much. And they also aim to maintain a stable $1 net asset value, or NAV, per share. It's all about stability and liquidity.
So it's not just any old fund. It's a structure designed under very strict rules for safety, investing almost entirely in short-term U.S. government stuff and cash. Are there other regulatory requirements mentioned around the reserve?
Oh, absolutely. The S1 points out that licenses, like their New York BIT license, impose specific demands.
Like what?
Things like full backing one-to-one reserves, segregation from their own company assets, custody only with approved institutions, limiting reserve assets to very specific, safe things like those short-dated treasuries, and mandatory monthly and annual attestations by independent CPAs.
Wow. So their reserve operations aren't just internal policy, they're actively enforced by regulators with audits.
That's the picture they paint, yes.
Okay, so the foundation seems built on, regulated reserves and transparency, at least according to the filing. But how do they plan to actually grow this network? How do they get more people, more businesses using USDC?
Their strategy, as laid out here, is very much partnership-focused. The goal is to attract a really broad ecosystem by integrating with, well, major financial institutions, fintechs, big internet companies all around the world.
Okay. Can you give us some examples? Any big-name partnerships highlighted in the S1?
Yeah, the list is pretty extensive and global. They mention integrating with Grab for a Web3 wallet over in Singapore, enabling USDC on major platforms like Mercado Libre in Latin America and Nubank in Brazil.
Big players in those regions.
Huge. Expanding access in Japan with SBI Holdings, facilitating remittances in the Philippines via coins.ph. They also talk about their strategic alliance with Binance to promote USDC globally.
And Coinbase. They seem deeply linked.
Very. Their deep, long-standing collaboration with Coinbase is mentioned frequently. Coinbase is both a key distribution partner and, as we'll get into, has a crucial commercial agreement with them.
Okay, any others?
Yeah, beyond distribution, they're working with institutional players like Cumberland for liquidity and settlement, and even exploring integration with the Intercontinental Exchange, ICE, for using stablecoins as collateral and for settlement. Maybe even co-branded ETFs down the line.
Wow, ICE. That's serious financial plumbing. So it's a really diverse set of entry points into different markets and different kinds of uses.
Exactly. And they also mention investing in ecosystem programs, developer programs with hackathons, events, their global alliance program. The filing stresses that these partnerships are just crucial for driving awareness and those all-important network effects.
Yeah, network effects are vital for anything like a payment system.
Totally.
So beyond just, holding USDC in a wallet, what kinds of products and services are actually being built on it or around it? How is it used?
The S1 breaks it down across a few layers. For consumers, it's integrated into a lot of applications and digital wallets. They mention reaching hundreds of millions of users through platforms like Coinbase, Robinhood, MetaMask.
The big names.
Yeah, and those partner integrations we just talked about, Mercado Libre, Nubank, coins.ph, Gcash in the Philippines.
Okay. And what about for trading? That seems like a massive use case for stablecoins.
Huge. Hundreds of exchanges globally list USDC. The filing highlights its increasing share of trading volume. It notes that as of early 2025, something like 9% of monthly spot trading volume on the major centralized exchanges was denominated in USDC.
9%. So it's become a really significant trading pair, not just against Bitcoin or Ethereum.
Right. It's used as the base currency or the, quote, currency in many pairs.
Got it. Any new product initiatives mentioned? Things on the horizon or recently launched?
Yes, a couple of notable ones. They got approval in Bermuda back in February 2025 to issue something called USYC.
USYC, what's that?
It's described as a yield-bearing digital asset. They plan to integrate it into their network. This is interesting because it offers users the potential to earn yield on a stable digital dollar, assuming it meets all the compliance hurdles.
Huh, yield bearing. Okay, that's different. What else?
They also offer Crcl liquidity services for their big institutional clients. This covers the core stuff: minting new stablecoins, redeeming them, managing foreign exchange needs.
And they recently launched something called the Crcl Payments Network, or CPN.
Correct. CPN launched very recently, May 24, 2025. This is framed as a new technology service designed to connect eligible financial institutions, think banks, fintechs, payment providers for real-time settlement using regulated stablecoins like USDC and EURC.
Initially focusing on cross-border payments.
That's the starting point, yes. Making international payments faster and cheaper using stablecoins as the settlement asset.
So they're building the actual rails for institutions to move stablecoins instantly between each other. What does the S1 say about how that actually works? Is it regulated?
The filing describes CPN as having a robust framework. Strict eligibility standards covering things like licensing, AML-CFT compliance, risk management, cybersecurity. They launched with 29 design partners, which suggests they're trying to get that institutional buy-in from the start.
Technologically.
Powered by smart contracts and APIs. So it's designed to be programmable and accessible for developers to build applications on top of it.
Sounds like a potentially significant step, trying to integrate stablecoins more deeply into traditional finance plumbing. Were there any older products they mentioned moving away from?
Yes, they list a couple of discontinued legacy products. Crcl Yield, that was a product offering yield on USDC deposits that ceased back in November 2022. They state there's no residual exposure left from that.
Okay.
And they also divested most of their equity crowdfunding platform, Seed Invest, in May 2023.
Right. Okay, let's switch gears. How does Crcl actually make money? According to the S1, what are the main revenue streams?
The primary driver by far is reserve income. This is the interest and the dividends they earn on those assets held in the segregated reserve accounts. The cash, the treasury securities, the shares in that Crcl Reserve Fund managed by BlackRock.
Okay, so interest income, essentially.
Essentially, yes. And crucially, the more stable coins like USDC are out there in circulation, the more assets they have sitting in those reserve accounts, which means, assuming interest rates don't plummet, this income stream grows.
So the total amount of USDC circulating and global interest rates, particularly US rates, are directly tied to their main revenue engine. Makes sense. What else contributes? Any other revenue?
There are other sources, yeah. They mention transaction services and integration services for their clients and partners, but reserve income seems to be the big one.
You mentioned that critical relationship with Coinbase earlier. How does the S1 describe the financial arrangement there? This seems really important.
It is, and this is a key detail revealed in the filing. They have this collaboration agreement with Coinbase, which became effective in August 2023. It completely changed their previous revenue sharing model.
How does it work now?
It's now based on something they call a payment base. This is derived from the daily income generated by the reserves backing USDC, but after deducting third-party management fees, like the fees paid to BlackRock for the fund.
Okay, so income minus fees. And how is that payment base split between Crcl and Coinbase? Can you break down that formula for us? Sounds complex.
It is a bit complex, yeah, but think of it in slices. First, Crcl keeps a very small slice for itself called issuer retention. It's just a tiny fraction of a percent on the total USDC outstanding, meant to help cover their basic costs of just being the issuer.
Okay, tiny slice off the top for Crcl.
Then, they split a significant chunk based on where the USDC is actually held. Crcl and Coinbase each get a share based on how much USDC is held in their respective custodial products. They call this party product economics.
So if Coinbase holds more USDC for its customers, it gets a bigger piece of this slice.
Exactly. And if Crcl holds more through its direct services, it gets more. After those amounts are taken out and some other bits for approved participants, Coinbase gets 50% of whatever's left of that payment base. That remainder is called ecosystem economics.
Okay, wow. So it's definitely not a simple 50-50 split on all the reserve income. It's heavily tied to who is actually custodying the USDC, plus Crcl's issuer fee, and then a 50-50 split on the rest. That's a complex financial alignment.
It really is. It incentivizes both parties to grow the amount of USDC held on their own platforms.
Looking at the financial trends overall in the S1, what does it show? How have things been going?
Well, the S1 highlights that reserve income increased significantly in 2024 compared to 2023.
Why?
They attribute it mainly to two things. First, a 9% increase in the average daily amount of USDC in circulation, so more USDC out there generating income.
Well,
And second, a 25 basis point, that's a 0.25% increase in the average yields they earned on the reserves.
and that yield increase directly linked to the Fed raising rates.
Directly linked, yes. They explicitly mention the U.S. Federal Reserve's interest rate actions as the driver for those higher average yields.
So higher interest rates were definitely a big tailwind for the revenue recently. What about overall profitability, net income?
The filing shows a bit of a swing. They reported net income of $155.7 million in 2024 and $267.6 million in 2023. So profitable the last 2 years reported.
Well, but before that,
Looking back to 2022, they actually had a substantial loss of $768.8 million. Well, it's been a turnaround. They also provide adjusted EBITDA as a non-GAAP measure, which gives another view of operating performance without certain items.
Where does the sheer scale of this stablecoin business really show up on their balance sheet? Is there one number that stands out?
Oh yeah, the key figure here is deposits from stablecoin holders. This is listed as a current liability, and it represents the claims of customers who hold their stablecoins, basically the value of all the USDC and URC out there.
And how big is that number?
As of March 31st, 2025, it was enormous. $59.9 billion.
Julian with a B. Wow.
Yeah. And the filing even notes this line item was highlighted as a critical audit matter by their auditors because of the sheer scale and the complexity involved in accounting for these massive flows. The segregation, the underlying smart contract operations, and making sure it all ties out correctly.
Understandable. That's a huge number and really underscores the scale, the responsibility they hold. Any other financial details that jumped out at you from the S1?
They note changes in cash flow. They went from using cash in operations back in 2022 to actually generating cash from operations in 2023.
Yeah.
Again, largely driven by that big increase in reserve income and the changes in how they share it with Coinbase.
Okay. Costs.
IT infrastructure costs are increasing as they scale, which makes sense. Marketing expenses actually decreased recently, and they had a one-time gain from selling off most of Seed Invest back in 2023. They also mentioned needing additional capital to fuel future growth.
Right. IPOs are often about raising capital. Okay, we've got a picture of the business, the growth engine, the financials, but who are they actually competing against in this rapidly evolving space?
They describe them as large, evolving, and intensely competitive. No surprise there. Their most direct competitors are, of course, other private issuers of stablecoins.
Like Tether.
They specifically call out USDT by Tether. They note its significantly larger circulation volume and acknowledge the potential impact it can have on the market dynamic, including on Circle's own business.
Right. USDT is the giant in the room. Are there other kinds of competitors entering the fray?
Absolutely. They list a whole range. Technology startups building new things, newer yield-bearing digital assets. They mention tokenized money market funds, or TMMFs specifically.
Those are getting attention.
Yeah, and they anticipate increasing competition from existing digital asset platforms, major traditional payments companies, large asset management firms. Banks may be launching their own digital currency initiatives, and also decentralized algorithmic tokens.
So it sounds like pretty much anyone looking to digitize value or move money instantly online could potentially become a competitor down the line.
That's the sense you get, exactly. And the S1 highlights network effects as a key factor here.
Meaning the bigger you get, the more useful you are.
Right. And conversely, if a competitor grows very rapidly, or if a really well-established player enters with significant resources, it could potentially gain market share quickly and limit Circle's own viability or growth. They even point to USDT's growth coinciding with a period when USDC circulation actually declined. That was late 2022 into late 2023 as an example of these competitive dynamics playing out.
Okay, that makes sense. All right, let's move from the opportunities and the engine to the potential pitfalls. The S1 filing, as you said, is full of risks. What are the most significant red flags or challenges that Circle identifies about its own business?
Yeah, this section is extensive, as you'd expect in an S1. I'd say the number one challenge they detail repeatedly is the regulatory landscape.
Oh, so?
They state they are subject to extensive, highly evolving, and often inconsistent regulations across many different jurisdictions. We're talking banking laws, securities laws, money transmission, privacy, sanctions, AML, CFT, tax. The list just goes on.
And the problem is these laws weren't written for crypto.
Exactly. Many existing laws predate digital assets entirely, which creates huge uncertainty. They explicitly note that regulators might disagree with Circle's own interpretations of these laws, or they might heavily scrutinize their partnerships. And non-compliance. It isn't just a slap on the wrist.
What can happen?
It could lead to massive fines, losing licenses, being forced to limit services, and of course, severe reputational damage, which is critical when you're asking people to trust you with their money.
That sounds like navigating a minefield basically every single day across dozens of countries.
It really does paint that picture. Another significant risk they highlight, and they frame it as unlikely, but they have to disclose it, is the potential of being deemed an investment company under the U.S. Investment Company Act of 1940.
Why is that a risk?
Because that law wasn't designed for companies like Crcl, and it imposes very strict limitations on operations and investments. If that were to happen, it could be a major problem unless they qualify for a specific exemption or safe harbor, which isn't guaranteed and could force significant changes to how they operate or manage reserves.
Okay. What about complying with sanctions? That's a huge focus globally right now.
Yep, they explicitly state they must comply with OFAC,
Uh-huh.
the U.S. sanctions body, and similar international sanctions programs. They say they have processes in place, but the risk of, accidentally failing to identify a sanctioned entity or transaction, that remains a significant concern.
And in this digital world, cybersecurity and data privacy must be huge risks too.
Absolutely. The S1 details significant risks related to just obtaining and processing the vast amounts of sensitive customer data they handle. They also specifically call out risks from their increasing use of AI, machine learning, and data analytics.
Risks like what from AI?
Things like potential intellectual property issues, new cybersecurity vulnerabilities,
Hmm.
operational risks if the AI makes mistakes, and general technological risks from relying on these complex systems. And, of course, the ever-present risks of fraud and hacking attempts through online financial channels. Any kind of security incident could trigger massive costs, regulatory notifications, enforcement actions, litigation, the whole 9 yards.
Yeah, a data breach would be devastating. Given they operate a network and rely on partners, are there risks related to depending on others?
Yes, that's another key disclosed risk.
Mm.
They admit they rely heavily on various third parties for crucial functions,
Such as?
safeguarding customer funds, aspects of their core operations, providing liquidity. They specifically name exchanges, custodians, and even BlackRock for managing the Circle Reserve Fund as examples. If any of these key third parties fail, or even just experience significant issues, it could cause serious harm to Circle's operations and reputation.
Makes sense. Let's get specific now to the risks of actually issuing stablecoins. What's the nightmare scenario they have to detail in the S1?
The big one, the classic one, is the potential for rapid redemption requests. A run on the stablecoin.
Like a bank run, but for stablecoins.
Yeah, exactly. They say this could happen, especially in extreme market downturns or if there are widespread market concerns about their reserves, their operations, or just stablecoins in general. The risk here is potential delays in meeting redemption requests, or in a truly catastrophic scenario, the reserves being insufficient to meet all redemption demands simultaneously, though, again, the reserve structure is designed specifically to mitigate this risk.
Right. And how do developments with other stablecoins factor in? You mentioned USDT earlier as a competitor. Is its stability a risk for Circle?
This is fascinating
Yeah.
and, yeah, concerning. The S1 explicitly states that adverse developments or instability regarding other stablecoins, particularly USDT, given it's much larger, could severely impact trust in all stablecoins, including Circle's own USDC and UORC.
So trouble for Tether could mean trouble for Circle, even if Circle did everything right.
Potentially, yes. A run on USDT, for instance, could not only damage the overall perception and trust in stablecoins globally, but it could also cause operational difficulties for Circle. Imagine sudden, massive inflows into USDC as people flee USDT that could strain their systems too.
Wow, so the stability or instability of the whole ecosystem is a direct risk factor for them. Any other notable risks that jumped out from that huge section?
Um, they list difficulty maintaining or entering into new distribution partnerships as a risk that could negatively affect the circulation of USDC and URC, and therefore their financial results. They also have to disclose specific ongoing legal disputes.
Like what?
There's a specific lawsuit mentioned with an investment bank, financial technology partners, or FT partners. It's about alleged fees related to past engagement letters. The filing gives the court details Southern District of New York and states that Circle is strenuously disputing FT partners' demand.
Okay, so active legal battles add another layer of uncertainty and potential cost. Let's shift gears again and look inside the company's structure itself. Governance, how decisions are made, the people involved. What does the S1 tell us?
Okay, structure. Circle is incorporated in Delaware, like many U.S. companies. The S1 details their stock structure, which is a bit complex. There are three classes of common stock.
Three classes.
Yeah. Class A, common stock, gets 1 vote per share. This is likely what would be offered to the public. Class B common stock gets 5 votes per share, but there's a cap. So Class B holders in aggregate can't control more than 30% of the total voting power. And Class C common stock has no voting power at all.
Interesting structure. And who will hold the most voting power after the IPO?
The filing indicates that the directors, the executive officers, and certain affiliated entities, likely early investors and founders, will collectively hold about 31.9% of the total voting power immediately after the offering.
So nearly a third. That gives him significant influence.
Significant influence, yes, over matters requiring stockholder approval, like electing the board of directors, approving major transactions like mergers. It could potentially make it harder for outside shareholders to push for a change of control they don't support.
What about the board of directors itself? Any structural points there?
Yes, the board is classified, it's divided into 3 groups, and each group serves a staggered 3-year term.
What's the effect of that?
It basically means you can't replace the entire board in a single year. It takes longer, potentially several years, to change a majority of the board through standard annual elections. This can also deter hostile takeovers. Amendments to the company bylaws can be made either by a majority vote of the directors or by stockholders holding a supermajority 66 and 2/3% of the total voting power.
Okay. Are there rules mentioned about large shareholders or potential takeovers, anti-takeover measures?
Yes, they are subject to Delaware's Section 203. This is a standard state law that restricts certain types of business combinations with stockholders who acquire 15% or more of the company's stock, usually for a period of 3 years, unless specific conditions are met, like getting board approval beforehand.
And rights for early investors.
Also mentioned, certain existing stockholders have registration rights. This means they can require Crcl, under certain conditions, to register their shares for public sale later on, making it easier for them to sell their large blocks of stock.
Got it. Are they planning to pay dividends to public shareholders?
The S1 explicitly states they do not currently expect to pay cash dividends on the Class A common stock. They intend to retain future earnings, if any, to finance growth.
Okay. No dividends expected.
Right. They do include the standard tax information disclosures related to potential future dividends or stock sales, things like backup withholding rules, FTIA implications for foreign holders. But note that proposed regulations mean FTISA likely won't apply to proceeds from selling stock in most cases.
And for employees or those early investors holding restricted stock, how does that work after the IPO? Can they sell immediately?
Not usually immediately. After the offering and any required lockup period expires, typically 180 days, those restricted shares can potentially be sold publicly. This can happen either through a formal registration statement or, more commonly for individuals, using exemptions like Rule 144 under the securities laws.
Rule 144.
Yeah, Rule 144 allows public resale of restricted securities if certain conditions are met. These usually relate to how long you've held the shares, limits on the volume you can sell in any 3-month period, especially for company insiders or affiliates, and a requirement that current public information about the company is available.
Okay. Let's dive into executive compensation. Who are the key people running the show, and how are they compensated, according to this filing?
The filing identifies the top executives, the named executive officers or NEOs. This includes CEO Jeremy Allaire, CFO Jeremy Fox-Geen, and executives named Elizabeth Carpenter, Heath Tarbert, and Nikhil Chantok.
And their salary.
The S1 lists their 2024 annual base salaries. For example, Mr. Allaire's was $900,000, and several others were around $500,000. It notes that most of these base salaries are staying the same for 2025, although Mr. Chantok, the Chief Product and Technology Officer, received an increase to his target bonus percentage.
How are those bonuses structured? Is it just discretionary?
No, they have a formal cash-based short-term incentive plan, or SDCP. It pays out annually, but performance is measured over semi-annual periods.
And what determines the payout?
Payouts can range from 0 up to 150% of the executive's target bonus amount. It's based on a mix. 70% is tied to achieving a financial target, something called set-adjusted EBITDA, and the remaining 30% is based on achieving specific non-financial business goals.
Do they list those goals?
They do for the second half of 2024. The goals included things like closing key strategic partnerships, enabling monetization of services, opening new reserve bank accounts, laying groundwork in new international markets, and launching specific blockchain infrastructure components.
Okay, so it's tied both to the financial bottom line and hitting key strategic milestones. Makes sense. What about equity compensation? Stock options, RSUs.
Yes, executives and other employees receive equity awards. These could be stock options, restricted stock units, RSUs, and sometimes performance-based awards granted under various company stock plans.
How do those RSUs typically work?
Often, the RSUs mentioned have a double trigger vesting condition. This means 2 things need to happen for the shares to become fully yours. First, you have to continue working for the company for a certain period, service vesting, and second, a liquidity event like this IPO needs to occur.
So the IPO itself unlocks a lot of value for employees holding these RSUs.
Exactly. There are also standard provisions for potential accelerated vesting of equity awards if certain corporate transactions happen, like a merger or acquisition.
The filing also mentioned an employee stock purchase plan, an ESPLU.
Yes, they have an ESTP. This allows eligible employees to buy shares of the Class A common stock, usually at a discount, through convenient payroll deductions. Typically runs in 6-month offering periods.
Is that common?
Very common for public tech companies. It's a way to give broader employee ownership. There's an initial pool of shares allocated to the ESPP and an automatic annual increase mechanism to replenish the pool over time, though it's capped.
Any other sort of unique or notable compensation details mentioned?
One interesting detail is they mention covering personal security expenses for the CEO, Jeremy Allaire. They cite specific safety concerns related to his high-profile position as the reason.
Understandable in this space.
Yeah. They also make a point of stating they have policies against providing excessive perks or benefits, and they prohibit executives from hedging or pledging their Crcl securities.
Okay. Beyond the named executives, who are some of the other notable directors mentioned on the board?
The filing lists several other directors. Names include Craig Broderick, M. Michelle Burns, who chairs the Nominating and Governance Committee. Rajiv Date, noted as becoming the lead independent director in late 2024, Bradley Horowitz from Google Ventures, who was appointed in late 2024 as well. Also co-founder P. Sean Neville, David Orfau, and Danita Osling. They also note the resignation of a director, Ms. Sands, in October 2024, and mention the vesting of her outstanding RSUs upon her departure.
How does the S1 describe the company's culture? Do they talk about that?
Briefly, they state that their mission and their core values, particularly emphasizing high integrity, form the heart of their company culture. They also mention their commitment to pledge 1%, which involves dedicating shares or equity to the Crcl Foundation as part of their social impact efforts.
Okay. Are there any specific accounting notes or policies buried in the footnotes that provide interesting insights into how they operate financially?
Yeah, a couple are worth noting. First, they adopted new accounting guidance for crypto assets early ASU 2023-08 effective January 1st, 2024.
What does that mean in simple terms?
It means they now have to measure certain crypto assets they might hold at fair value, with changes in that fair value flowing directly through their net income statement each period. This generally increases transparency about market value, but can also introduce more volatility into the reported earnings based on crypto price fluctuations.
Right, makes sense. What else?
They also discuss the accounting for that massive liability, the obligation to return digital asset collateral, basically, the money owed back to stablecoin holders. They treat this complex item as a hybrid instrument that includes an embedded derivative, and they measure it at fair value each period. Changes in its fair value are recorded in their digital assets' gains or losses. They note they used to use a fair value hedge relationship for this, but stopped when they adopted that new crypto accounting standard.
So their financial reporting now reflects the current market value of those assets and liabilities much more directly than before.
Exactly. One other item, they provide some detail on the Cybavo acquisition. Cybavo was a crypto infrastructure company they bought.
When was that?
The exact date isn't specified in the notes I saw, but it's referenced in the filing context. They paid around $142 million, a mix of cash, USDC, and Crcl shares. When they accounted for it, they booked acquired intangible assets, things like developed technology, customer relationships, the Cybavo trade name, and also recorded goodwill.
And goodwill represents?
Goodwill generally represents the excess purchase price over the fair value of the identifiable assets acquired. It's attributed here to things like the value of Cybavo's skilled workforce and expected synergies from combining the businesses.
Okay, that gives us a good overview of the structure, the people, and some of the key accounting things behind the scenes. Finally, let's talk about the reason this S1 exists. The potential public offering itself. What are the basic details?
The filing specifies that the offering consists of shares of Class A common stock. Importantly, these shares are being sold by both Crcl itself, raising new capital for the company, and by some existing selling stockholders who are cashing out some of their holdings.
Okay, and who are the big banks managing this IPO underwriters?
JP Morgan, Citigroup, and Goldman Sachs are listed as the joint book-running managers and representatives of all the underwriters involved. That's a top-tier group.
And do the underwriters have an option to buy more shares?
Yes, there's a standard greenshoe option or over-allotment option. The underwriters have the option to purchase up to an additional 3.6 million shares of Class A stock from Crcl, likely to cover excess demand if the offering is popular.
And the expected delivery date for the shares?
It's stated generally as being on or about a specific date in 2025, subject to closing conditions. The shares would be delivered electronically through the Depository Trust Company, or DTC, which is standard practice. The filing also, interestingly, touches upon the complexity of offering shares internationally, mentioning specific legal restrictions and disclosures required in places like the UK, Canada, and Singapore, just as examples.
Right. Global offerings add layers of rules. Wow. Okay, we have really taken a deep dive into this S1 document today.
Yeah. We certainly have. We've navigated through Circle's core mission, which is built around these regulated stablecoins like USDC. We've explored their partnership-centric growth engine, examined their financials, which are significantly impacted by reserve income and prevailing interest rates. We looked inside their corporate structure, their governance, and crucially, we delved into that extensive list of risks they felt obligated, legally required to disclose.
Yeah, the key takeaways seem pretty clear. Circle is positioning itself as like foundational infrastructure for a new kind of digital financial system anchored by USDC. Their success really hinges on growing that network through all those strategic alliances and carefully managing the income generated from their vast reserves.
But
But yeah, the S1 makes it starkly clear they operate in a ferociously competitive and incredibly complex, highly regulated environment. They're facing everything from the potential for market runs and huge competitive threats like USDT to navigating this patchwork of inconsistent global regulations and managing significant operational and legal challenges daily.
this document really provides a powerful window, doesn't it, into the realities of trying to build something truly new at the sort of bleeding edge of finance and technology. It shows the immense potential, but also lays bare the formidable hurdles.
It absolutely does. And as we wrap up this deep dive, it really leaves you, the listener, with a pretty provocative thought, I think. This S1 highlights the transformative potential of programmable money, right? Using smart contracts to unlock all sorts of financial innovation.
Yeah, and that's the vision.
But it also meticulously details the inertia of the existing system, the regulatory friction, the intense competitive battles. So, as we move forward, what will be the ultimate constraint in bringing this vision of programmable dollars to everyone? Is it going to be the technology itself? Is it the incredibly complex web of regulations? Or perhaps is it something far more fundamental, like building and, more importantly, maintaining human trust in these new digital forms of money?
Hmm. That's the multi-billion-dollar question, isn't it?
Indeed, it is something to think about.